remember. Now, courts have had a number of cases where doctors sharing office spaces are perceived to be partners, even though they don't have a formal partnership agreement, even though they kept separate books, file separate tax returns, never held themselves out to the IRS as partners. They have allowed lawsuits to go forward. And part of it is a matter of that they have to look at it from the point of view of the injured plaintiff to decide whether they knew or should have known that these two people were not partners. Was there a plaque outside the reception desk saying we're all sole practitioners here, we're not partners? Or wasn't there? Was there some notice given to the patient? You'll see a question, one question on your exam about the older chiropractor who rents out space and provides services to a tenant. And the tenant will either, in the question that you'll get, it'll have the chiropractor either having a receipt for a fixed amount of money each month, or based on X dollars, or based on a percentage of what the tenant receives from his building. And the question goes to the point of did the owner chiropractor profit from a misdeed or false billing or fraud by the owner chiropractor? Dr. Smith rents out space to Dr. Jones. In their agreement, Smith will provide reception services, supplies, copy, allow him to use his copying machine, and also a bill. And Dr. Jones, and then at the end of the month, Dr. Smith will receive 10% of any proceeds received by Dr. Jones as a result of the billing. Dr. Jones commits fraud in his billing. Did Dr. Smith be civilly liable, held civilly liable? And the answer is yes. The boards and the courts have held, yes, they can. Even though they're not partners, as in their mind, they both are equally benefiting from the fraud, so Smith would have the legal obligation to ensure the fraud did not occur. Also have the ethical obligation to ensure the fraud did not occur, and so if it did occur, he would be held responsible by the board for the fraud. The other type of question, and the same idea, is that with the same facts, the Smith receives just based from the billing, he receives X dollars per month for rent and supplies and all that, not based on a percentage. And if it's not based on a percentage, then there's no obligation by Smith to verify fraud is not occurring, therefore he could not be held responsible for that fraud. And so you'll see that question on your exam in one of the two different versions. If Smith is receiving a percentage, then he will be held as a partner, civilly liable. He'll also be held responsible by the board of chiropractic standards for the fraud. If he's receiving a fixed amount for X dollars based on whatever services he's providing, and not based on a percentage, then he will not be held responsible, either civilly or by the board. So you'll see one of those two versions on the exam. So don't be fooled by that. You'll see a couple of you'll see one question. I'm not sure what question you're going to see regarding liability insurance. Keep in mind on liability insurance, and it'll be a question mixed deal with the statute of limitations and statute of repose. But keep in mind on liability insurance that every doctor, whether he's an employer or employee, whether he's a partner or whatever, That covers everybody else in the clinic, but it doesn't cover the professional providers. You've got to have your independent, individual policy. Point two, the liability policies, the great majority, 99.999% of the liability policies are what we call claims-made policies. The claims-made policy says that essentially the insurance company that's insuring the doctor at the time that the claim is made, not when the malpractice occurred, which that could be a different time, when the claim is actually discovered and made, is the one generally responsible for insuring the doctor. And so if you go from job A and insured by insurance company A to job B, the question is, well, who's responsible for covering it? And it really depends on the policies that you have. For insurance company, for claims-made policies, we have again, it's the insurance company is obligated to defend and pay out on the policy at the time the claim is made, if they're contractually obligated to do so. We have the idea of tail coverage. You have a fixed policy that covers you at say one point in time, but it also has what we call tail coverage, so that after you leave, say, this job, this clinic, it will continue to cover you for a fixed period of time. And we also have, and usually we recommend that you have it for the full 5-year statutory post. Tail coverage for 5 years and more. We also have the idea of head coverage, which is much more expensive than tail coverage, where if you buy a new policy, you can contract with the insurance company to, say, go back in time to cover preceding times or preceding malpractice claims that weren't made for a fixed period of time. And if you're going to do that, then of course you would want to have head coverage for any gap in time between the end of your last employment, your last clinic, or the last policy you had for coverage, and the initiation of this new policy. So the question again that you'll see on your exam is really trying to figure out which insurance company is responsible for covering you during any period of time. So, for example, we would have, here, just let's take one up here. Dr. Smith is working for the Selwood Chiropractic Clinic as an employee in 1990. He and is insured by insurance company A in 1990. In 1992, he decides to open up his own clinic. So he quits his position and lets his insurance lapse while he's working out the business provisions and organizing his new clinic. And in 1994, he finally gets together and opens up his new clinic. So he works at Selwood Chiropractic Clinic from 1990 to 1992. He quits and lets the insurance company A lapse. And then in 94, opens up his own practice, and then at that time, contracts with insurance company B. So assume then that